Good evening. I'm your host, and this is KPC News Update today. In a landmark move that could reshape the nation's economic landscape, President William Ruto has signed the National Infrastructure Fund bill into law, unlocking a staggering 5 trillion shilling war chest for development. The first beneficiary, Jomo Kenyatta International Airport, which is set for a massive expansion funded by proceeds from the recent Kenya Pipeline Company IPO, but this ambitious plan raises critical questions about financial sustainability, execution capacity, and national priorities. Tonight, we dive deep into what this 5 trillion shilling fund means for Kenya's future. We'll examine the mechanics, the promises, the potential pitfalls, and the perspectives from across the economic spectrum. This is a 12-minute deep dive into Kenya's boldest infrastructure financing gambit yet. Let's start with the core announcement. At a signing ceremony at State House, Nairobi, President Ruto described the establishment of the National Infrastructure Fund as, and I quote, the most consequential initiative in the development history of the nation. The fund has been established with a 106 billion shilling seed capital raised through the Kenya Pipeline Company initial public offer. This is not a small amount. 106 billion shillings is a significant injection, but the ambition is far greater. The fund is designed to leverage this seed money to eventually mobilize a total of 5 trillion shillings. That's 5 trillion shillings. The president stated that the fund will help narrow the infrastructure financing needs of the country, which the World Bank estimates to be about $4 billion annually. That's a $4 billion annual gap. So, how does a 106 billion shilling seed become 5 trillion shillings? The government's plan involves a multi-layered financing strategy. The seed capital from the KPC IPO acts as an anchor. The fund will then seek to attract additional capital from multilateral development banks, private institutional investors, pension funds, and sovereign wealth funds. The idea is to use public capital to de-risk projects, making them more attractive for private investment. This is known as a blended finance model. The government hopes this structure will circumvent the traditional constraints of the national budget and public debt ceilings. However, financial analysts we spoke to highlight a critical tension. The success of this model hinges entirely on the fund's ability to generate a commercial return on investment. Infrastructure projects, especially large-scale transport hubs like airports, are notoriously capital-intensive with long gestation periods before they become profitable. This brings us to the first major visual. Let's look at the projected scale of this financing gap. Now, the immediate and symbolic first project is the expansion of Jomo Kenyatta International Airport. JKIA is already East Africa's busiest aviation hub, handling over 7 million passengers annually. But it has been operating beyond its designed capacity for years, leading to congestion and operational inefficiencies. The expansion plan, details of which are still emerging, is expected to include a new terminal, additional runways, and upgraded cargo facilities. The goal is to position JKIA as a premier global transit hub, competing directly with the likes of Addis Ababa's Bole International Airport and Dubai International. Proponents argue this is a strategic necessity. Kenya's economy is heavily reliant on tourism and horticulture exports, both of which depend on efficient air connectivity. A modern, expanded JKIA could boost passenger traffic to 12 million annually and significantly increase cargo throughput. But critics immediately question the logic. Why start with an airport? And why use proceeds from a profitable state asset sale to fund it? This leads us to the debate around the Kenya Pipeline Company IPO itself. The government raised 106 billion shillings by selling a 25% stake in the pipeline monopoly. The KPC is a cash cow, responsible for transporting nearly all of Kenya's fuel from the port of Mombasa inland. Selling a quarter of it provides a one-time cash infusion, but it also means forfeiting a quarter of its future dividends. The fundamental question is whether this is prudent asset management or a short-term fix. Is it wise to sell a profitable, strategic asset to fund a new, risky project? Dr. Aisha Mwangi, an economist at the University of Nairobi, offers a stark perspective. She states, this is akin to selling the family cow to buy a potentially faster, but untested horse. You get a large sum up front, but you lose the steady supply of milk forever. That's a powerful analogy. Let's visualize her quote. To understand the scale of what's being proposed, we need to put 5 trillion shillings in context. Kenya's entire national budget for the 2024/25 financial year is approximately 3.9 trillion shillings. This fund aims to be 28% larger than the entire government's annual spending plan. It is equivalent to roughly 35% of Kenya's current gross domestic product. The breakdown of how this money would be allocated across sectors is crucial. While the initial focus is on JKIA, the fund is mandated for national infrastructure broadly. This includes roads, railways, ports, energy, and digital infrastructure. According to preliminary framework documents, the intended allocation is not evenly spread. Let's look at the proposed sectoral distribution pie chart. Transport, led by the JKIA expansion and other mega projects, takes the lion's share. This is followed by energy and water and sanitation. The relatively small slice for digital infrastructure has already drawn criticism from tech sector leaders who argue that broadband and data centers are the true engines of 21st century growth. Beyond the allocation debate lies the monumental challenge of execution. Kenya's history with mega projects is checkered. The standard gauge railway, while a physical success, left the nation with substantial debt to China. The Galana Kulalu food security project failed to meet its objectives. The Lake Turkana wind power project faced years of delays with transmission lines. Each of these projects encountered problems with feasibility studies, contractor selection, community engagement, or financial management. The question for the 5 trillion shilling fund is, what governance safeguards are in place to prevent similar fates? The government says it has learned from past mistakes. The National Infrastructure Fund will be managed by an independent board with representation from the private sector, academia, and civil society. It will operate under the public-private partnerships framework, but with enhanced transparency requirements. All projects will undergo rigorous feasibility and environmental impact assessments before funding is approved. Furthermore, the fund will not finance projects 100%. It will require significant co-investment from private partners, ensuring skin in the game. However, skepticism remains high. John Kamo, a governance expert with the Institute for Economic Affairs, points to a key risk. Independence in name is not independence in practice. The appointment of the board, the approval of projects, the selection of private partners, all these are processes vulnerable to political influence and vested interests. Without ironclad legislative and operational firewalls, this fund could become a 5 trillion shilling patronage machine. His concern is about the potential for corruption and misallocation on an unprecedented scale. Let's examine the potential economic impact more closely. If successfully implemented, what could the JKIA expansion and subsequent projects deliver? Proponents project a significant boost to GDP growth. The construction phase alone could create over 50,000 direct and indirect jobs. Once operational, an expanded JKIA could facilitate a 15% increase in tourist arrivals and a 25% increase in horticulture exports by volume within 5 years. The ripple effects on hospitality, logistics, and manufacturing could be substantial. The government's target is to use infrastructure spending to push Kenya's economic growth rate above 7% consistently. But these projections are optimistic. They depend on global economic conditions, regional stability, and Kenya's ability to market itself effectively. A more conservative analysis from the Kenya Association of Manufacturers suggests a realistic GDP boost from the JKIA project alone might be closer to 0.8% annually, not the 2 to 3% some government models suggest. Let's compare these two growth projections side by side. The regional context cannot be ignored. Ethiopia is aggressively expanding its aviation sector. Tanzania is developing its Bagamoyo port. Uganda is pushing for its oil pipeline. Kenya's move is partly a defensive play to maintain its position as East Africa's commercial and logistics gateway. If JKIA does not modernize, traffic could divert to Bole Airport in Addis, which is already a major hub for the continent. This is a competitive race. However, some analysts argue that regional collaboration, not just competition, is the smarter path. Could a portion of this fund be used to finance regional rail or power interconnectivity projects that would benefit the entire East African community and create a larger market for everyone? The current plan appears nationally focused, which may miss larger opportunities. Financing remains the elephant in the room. The 106 billion shilling seed is secure. Mobilizing the remaining 4.9 trillion shillings is the monumental task. The government plans to issue infrastructure bonds, secure loans from development finance institutions like the African Development Bank and the World Bank, and attract private equity. Each of these avenues comes with costs. Bonds pay interest. Loans have to be repaid with interest. Private equity demands high returns. The fund's projects must generate enough revenue through airport fees, tolls, energy sales to service these costs and provide a return. If they don't, the liability ultimately falls back on the Kenyan taxpayer. This creates a significant contingent liability for the national treasury. The National Debt Management Office has expressed caution, noting that while the fund's debt might be off the government's direct balance sheet, lenders will still look to the sovereign as a backstop for large-scale national projects. This could indirectly affect Kenya's credit rating and its cost of borrowing for other needs. Let's hear from a supporter of the plan. Michael Cheege, chairman of the Capital Markets Authority, sees it differently. He states, "This is a visionary leap. For decades, we've been trapped in a cycle of begging for donor funding or mortgaging our future with expensive commercial debt. This fund creates a Kenyan-owned, Kenyan-managed vehicle to build Kenyan assets. It deepens our capital markets by creating new asset classes for pensions and insurers. Yes, there are risks, but the risk of doing nothing, of letting our infrastructure crumble and our competitiveness fade, is far greater." His point about capital markets is crucial. The success of the KPC IPO showed there is significant domestic liquidity seeking investment opportunities. The infrastructure fund could channel that liquidity into productive national projects. Let's look at the potential sources for the remaining 4.9 trillion shillings. As we enter the final segment of our deep dive, we must consider the human and social dimensions. Mega projects like airport expansions are not built in a vacuum. They require land. The area around JKIA has seen rapid, often unplanned, urbanization. Any expansion will likely involve displacement and compensation. Kenya's record on fair, timely, and transparent compensation for large infrastructure projects is poor, leading to protracted court battles and social unrest. The fund's framework mentions a social impact mitigation clause, but the details are vague. Will this fund repeat the painful histories of previous projects, or will it set a new standard for community engagement and benefit sharing? Furthermore, with such a colossal sum focused on physical infrastructure, there is a concern about opportunity cost. Could some of this money be more effectively used to build classrooms, equip hospitals, or subsidize agricultural inputs for smallholder farmers? The government's argument is that first-class infrastructure creates the economic growth that then generates the tax revenues to fund social services. It's the classic growth first, distribution later model. Whether the public has the patience for that sequence, given current economic pressures, is a political question. In conclusion, President Ruto's 5 trillion shilling National Infrastructure Fund is arguably the most ambitious economic policy of his administration. It is a high-risk, high-reward strategy. On one hand, it presents a bold solution to Kenya's chronic infrastructure deficit, leveraging capital markets and aiming for commercial sustainability. A successful JKIA expansion could be a powerful symbol of national progress. On the other hand, the risks are enormous: execution failure, debt entanglement, corruption, and social displacement. The sale of the Kenya Pipeline Company, staked to seed the fund, remains a contentious trade-off between immediate liquidity and long-term revenue. The coming months will be critical. We will be watching for the appointment of the fund's independent board, the publication of its first investment pipeline, and the details of the JKIA expansion tender. This fund has the potential to transform Kenya's economic geography, but only if it is managed with unprecedented levels of transparency, competence, and integrity. The stakes could not be higher. For Kenya News Update Today, I'm your host. Thank you for watching this 12-minute deep dive. Subscribe to Kenya News Update Today for continued coverage of this and other critical national stories.